Good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader. And before we get into the good stuff, I want to remind everybody that futures and options trading contains substantial risk. It's not for every trader. You could potentially lose all or even more than all of your initial investment. And that's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. It doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results. And what we talk about here in this program contains neither trade recommendations nor financial advice, and therefore should only be used for educational purposes. And with that out of the way, it's my pleasure, as always, to welcome Anthony Crudele back to the show. How you doing, Anthony?
I'm doing great, Tom. How's everybody doing out there?
Oh, doing great. We're finally getting your weather. I don't know. It's been a while, but it's just it's like 70, 75 degrees today. And it's a great day to open up all the windows and kind of houses are insulated, so it's still kind of cool inside. And you open up the windows and it's like almost summer. It's great.
Yeah, that really ties into the topic that we're going to talk about today. I think everybody always talks about reasons to trade, but they don't spend enough time and find reasons when not to trade. Like, I have really started to pull things back as of late, and it's because of several reasons, mostly technical. And I'm going to go over the charts today and explain why I think it's just as important to focus on reasons not to trade than it is to focus only on reasons to trade. And I just want to really quickly explain why I think that that's such an important part of trading and finding reasons not to trade is because the number one way that I found to grow my P&L was not, this is going back when I had first started, was not necessarily finding ways to make more money. It was finding ways to lose less and to keep myself out of more bad trades, because we're all going to find good trades sometimes, right? And the reality of that is we don't know when it's going to happen, but we have to be around for it. And when it does happen, the market feedback is going to be very positive and it's going to show us on our results. So what I mean by that is when you have a winner on and when things are going well, the market gives you that feedback by your P&L growing, by the response to the market at your strategy points, and so on. When the market is not responding well to your strategy, when you are seeing scenarios that are kind of not A setups, but B or C setups, and you're taking them, they're just immediately against you, or some's a winner. And then it's like, okay. And then one day to the next, to the next, to the next, it's not carrying over. And it's totally breaking up your rhythm. You have to recognize that environment and see what is it that I can do to prevent this from happening in the future? Because most people out there can relate to me in this one stat here. You probably can go out there and make money at least 50 to 60% of the time, right? And you go out there and maybe you're not making as much money as you want, but maybe you might manage your risk perfectly. And maybe in a 20-day trading month, you may make money 13 to 16 times. And then you look at your results and you say, wow, I'm really just not getting anywhere, right? And it's because most of the time on the days that you were wrong, you were still maximizing your downside risk. And so you didn't keep yourself out of bad scenarios. Even though you did still manage your risk, you ultimately still stole from your future, is the way I looked at it, because you just have to work harder and harder to maintain that level, right? And that's why I say that it's not just easy to if you can make money with 2 lots, you can get to 200 lots. I thought that same philosophy would work for me. It took a lot more for me to eventually get to 200 lots. And it was about really recognizing scenarios, honing in on some very specific times when the market was giving me great feedback. And that was the time I was able to size up. And you're not able to size up on a random day just because it's an A setup in a B or C or D environment. And in order to do that, you have to size up when you're in an A setup in an A environment. And so today I just want to talk about putting some things into play. And this is my number one thing that I'm going to share with you today that I put in play that keeps me out of days like I've seen lately.
Well, and you bring up a good point, which is the reflection of, trying to minimize the losses. And you can look at this in kind of any atmosphere. It's looking to see where you could have done better, where you might have made a mistake, made a decision that resulted in a loss, that resulted in, suboptimal performance. And I think you're right. I think it's rather than focusing on what you do well, which is good, and trying to repeat that, but it's also where did I make my mistakes? And I talked about this before. In sports, it's not always about, hey, let's look and review what you did well. Sometimes it's really about, hey, if you could take back one pitch as a pitcher, which would it be? Okay, now let's see why that is, because that one pitch might have undone all the good stuff you did, right? And that's what you're talking about here is, 13 out of 16 sounds great, but if those three were really, really horrible, you want to focus on that as well.
Yeah, I mean, because if you really add it up, if you make $500 a day for 15 days, right? Because a lot of new traders will look at, I'm trying to make $500 a day or $200 a day or 100 or 1,000, whatever it is your number is. If you multiply that out and then you take the other days that you lost exactly what you made, plus expenses, fees, there's always fees, there's always something that costs you to do business, you're actually losing more than you should be, right? And so ultimately, you think that you're managing risk really well by only losing what you're making, but when in reality, those days, instead of maybe trying to make more in a B or C environment where the environment's not great, like I think this environment is like that right now, then you have to realize that you have to either reduce risk and take a smaller amount of loss on this particular day, or you have to find ways to just keep you out of those bad days. And what I want to do is I want to pull up the charts and I want to get into the nitty gritty here a little bit. And I'm going to go back to my days when I first started on the trading floor. Well, we could only see if we were up or down on a day. Now imagine that, everybody. Imagine coming into the day and only being able to know, oh, the Dow is up. Oh, it's up 110 today. S&P's up 6 and NASDAQ's down 20 or whatever it is, right? And you can only look at that. And a lot of that was determining what you were going to trade in the pit. And we obviously had to keep it super simple. And how did so many people make millions of dollars, right? And it's not always because we had the edge of being in the pit because of the brokers or whatever one would want to talk about. My mentor actually stood in the center of the pit and he looked around and he would analyze what's happening in the market. And one of the things that he taught me early on was strong days, everyone participates. Those are the days where you see the NASDAQ, Russell, Dow, S&P all up, and the upside leaders of the market are leading the way. That is a perfect scenario to where he steps in, looks for any sort of weakness, and just buys it. Sounds pretty simple, right? But those days don't happen all that often. In bull markets, they happen pretty often, but even those days aren't a ton of times where that happens. Weekdays are when everybody is weak across the board and everyone's participating and the downside leaders are leading the way, right? And you could just see that without even looking at anything. You can pull up the top 5 or 10 stocks in the NASDAQ and the S&P, and you could just see what they're doing. And you don't even need to look at the chart, right? You can look at the chart coming into the day and know who the leaders are. Then you have a divergence days, or you have divergence markets, where you have a strong NASDAQ, you have a weak S&P, or S&P in the middle, and you have a weak Russell, and you have, the Dow maybe in the middle as well. And you basically have sector rotation, which means that every day that comes in, and we're talking specifically for indexes here, you don't know what the big players are going to come in and buy. Are they going to come in and buy tech today? They're going to come in and buy energy. They're going to buy healthcare. They're going to buy utilities. They're going to buy industrials. You don't know. And what happens is that one day the Russell's down, the next day the Russell's up, next day the NASDAQ's up, the next day the S&P's down. And they're back and forth we go, and you basically have no idea what the market is going to really give you for the day because you have divergence every single day. And that is the current tape that we have. And this is why indexes are so difficult right now, because you have massive divergence across the board. And that to me is the most difficult environment for index traders. And some traders will say, well, why do I care about the macro environment? That doesn't matter for me. Well, it goes back to limiting bad days. The short-term trades that you're going to get may not have direct impact from a bigger picture divergence or a bigger picture news or something that's happening, whether you're talking about inflation, Fed, or whatever. It may be just that day, that sector is just out of favor, right? And so what happens is you start to realize that, wow, I'm doing the same thing today as I did yesterday, and I can't make money with it. And when you look at the chart today, when I pull up, I'm starting with the S&P, because the S&P, what we learned was the center of the universe, right? The S&P pit, we used to make a joke, we were the center of the universe, right? And that was kind of the ego from the pit guys. But ultimately, that is where a majority of the action takes place. The big game, everybody, is the S&P futures. It's not SPY. It's not anything else. The big game is the S&P futures. That is where the action takes place, okay? So therefore, if they're up or down or whatever the S&P is doing, a lot of times that is going to get a push or a pull from what's happening in Russell, Dow, or NASDAQ, okay? Because the S&P is the big game, it's going to have its tentacles into everything else, but they also have feedback into the S&P. And so the S&P a lot of times is going to be in the middle of the road. When you have a bull market, it won't be the top performer. And when you have a bear market, it won't be the weakest. It's a lot of reasons why everybody matches everything against the S&P as well. So when you come in, you look at the S&P, you say, where is it? And what I like to look at is, as you guys know, I've talked about this a million times. I just use the auto-anchored VWAPs from the beginning of each and every month. I just have them anchored there. Okay. Above it, where is green, below it is red, and I put in a 10-day moving average because that suits my time frame the best. So at this point, you have a very simple look at the market. And what I want to start to see is the S&P establishing itself above a 10-day moving average and above an auto-anchored VWAP. And you can see here for the month of April, it is just about the choppiest you're ever going to see. I'm above it, I'm below it. I'm above it, I'm below it. 10-day moving average is the exact same place as the monthly VWAP. Really doesn't get much tougher than that. And so then you pull in the NASDAQ. NASDAQ's near the highs of the year. It's actually below the 10-day, and it's actually below the auto-anchored VWAP, but yet it's near the highs of the year. So now you have the S&P, which is actually pretty close to the highs of the year as well, but it didn't make a higher high like NASDAQ did in April. And now you have this divergence, right? So now the S&P is trying to gain strength, and now the upside leader is not leading the way. Because now we've established that the S&P knows what everyone else is feeling, but when you look at the NASDAQ, it needs that burst to rally. So every time you look at the S&P, goes to a new high, bang, they sell it off. Goes to a new low, boom, they rip it up. So buying into rallies and selling into breaks is the pathway to the poorhouse or the insane asylum, because you're basically looking at what's happening in the S&P and you think, wow, it's establishing the strength. But then when you look at the NASDAQ, it may look strong on the chart, on just a regular bar chart. But then when you look at it as relative to some basic indicators, it can't get out of its own way. And so you have this divergence happening again. You have upside leaders not getting full participation to helping the big boy move forward. And then one more thing, I'll go to the Russell. I don't show the Dow because I don't really look at the Dow as much, although I probably should be including that in today's show. But look at the Russell near the lows of the year, but yet it's above the 10-day and it's somewhat holding above the auto-anchored VWAP. And it is basically, just chopping around for this month as well. So now you have the downside leader trying to participate in rallies. And it's the same story where you don't have full participation. You don't have everybody saying, oh, I like this market. You have different sectors on different days that choose to do different things. And so when you peel that back and look at it, the only time you're going to find days where things are very clear is when the upside leader is leading to the upside. It's above everything. It's making highs. The S&P's established itself above its basic technicals, and the downside leader is at least semi trying to participate in it. And then maybe you have a follow-through day. And until that happens, you're going to be buying into rallies, selling into breaks, range-bound type markets. And so you have to realize intraday, you have to either reduce risk, You have to take the position sizing down, and you have to realize that the volatility is decreasing because of divergence. And maybe you won't get that 10-point move you were looking in the S&P. It might only be 4 to 6. And whether you're trading NASDAQ or any other market, you realize why this is happening. So you have to put it in perspective and look at it and help you really get in tune with the environment.
So a lot to unpack there, Anthony. Thank you for that. Looking at the charts as well, based on what you said with the anchored VWAP and the moving average, it almost seems like there's a little bit of consolidation going on. We can see that on the charts. Although you did mention the Russell, the Russell is trying to participate in this uptrend, but the NASDAQ really isn't. The NASDAQ is below the indicators. S&P just got above, but it's not making new highs. Seems like a lot of uncertainty, a lot of sideways motion. But if something were to change, let's say the NASDAQ did stay above its anchored VWAP, it did cross above its 10-day moving average. Are you favoring the NASDAQ here, or are you saying, the Russell's been here for a little bit, it's been above these indicators, it's the lowest one, it's the weakest, I should say, not the lowest one, it's the weakest. Are you putting more of a favorable view on the NASDAQ? And again, this is speculation, this isn't what's happening now, but are you looking at NASDAQ and saying, okay, game on because it got above those indicators? Or do you need something more to say, I know it just crossed above the 10-day, I know it just got above the VWAP, but I want to see some more follow through before I'm really bullish about this?
Well, I primarily trade S&P and NASDAQ, and Russell, I don't trade intraday as much. But ultimately, I think the product that you're trading, most people are probably going to be trading the S&P, obviously, right? Because that is like I said, that's the big boy. That's where the big game is. But I don't really hop between the indices as much in a divergent tape. If we were all up and we all look similar to the NASDAQ and we were all going to the upside, I would trade the NASDAQ because the NASDAQ would be the strongest one. A guy said to me one time, he goes, Anthony, how are you ever going to beat the market if you're not trading the one that's outperforming everybody else, right? And so when you look at it from that perspective, it's like trying to buy the Russell, which is the weakest market, in an up tape. You're expecting the weakest market to make up for it, what the strongest market is already doing. And that is the most difficult thing to do because you're asking this one to do a one-off. You're basically looking for a lotto ticket in a sense, because you're saying today's the day the Russell's going to catch up. And it just never does, right? The one that's the strongest always is the one you want to trade to the upside. So in an environment where if I were to see everybody participating to the upside, I would want to trade always the strongest one. And that would be the one that's nearest the highs or the possibility of going through its highs, which would be the NASDAQ, right? And so that to me is always where I want to be. I never want to be trading the weak or the one in the middle and hoping that on that day, they're the one that catches up.
Got it. Now, I did have a question about divergence because, you really did describe what divergence is amongst the stock index futures. Could it be a situation, though, where today all stock index futures are up, but NASDAQ is up, 1.25%, and the Dow is barely 0.25% up? I mean, there's a big difference. Would you call that kind of a divergent environment, even though let's say Dow was just a tick above unchanged? Would you consider that divergent, or do you really look and say, okay, this one's down today, but this other index is up?
What I would look at divergence would be one would be up, one would be down, not necessarily if they're all up. But I would say this is that it goes back to sector rotation type market. This is where we are right now. And most of you out there, if you watch stocks like I do as well, you can just, it's plain as day. You see sector rotation constantly right now. And that is such a difficult thing for index traders because you just don't know which day the index is going to perform the way that you would like it to. So ultimately, you have so much back and forth that everyone goes, gosh, I'm so tired of these prices, right? I mean, the S&P feels like it just keeps trading in the same range. Although it is ultimately inching higher, for day traders, it's like, okay, is today the day they're going to keep going up or not? And the reason why I did this show today is because you have to start pulling back expectations of rallies, and I think breaks as well, is because the upside leader this month is all red in terms of where we are to the VWAP and where we are to the 10-day moving average. You cannot get an S&P. It's not going to all of a sudden do everything you want to do and take out the highs of the year if the NASDAQ isn't giving it what it wants. Because the NASDAQ, remember what I said before, the tentacles all come into the S&P. And so if the S&P does not see and feel that everyone is participating, you get divergence. The rally gets sold. You see a lot of gap ups that fade. You see a lot of gap downs that get faded, right? And it's just that type of market. And it's very clear to me that that's the case because of what I see within the bigger picture. And this is so important because if you're a day trader just trading the S&P, a lot of you are probably being told, or you've seen other people say, the big picture doesn't matter if you're short term. That is complete nonsense. It's complete nonsense. It's just because they're saying that their strategy is only giving you the short-term signal. So therefore, that short-term signal only matters in that 1 minute or 5 minute or tick bar or order flow. And I get that. Look, I was a size trader when it comes to scalping. And I can tell you this, the greatest success I've ever had in scalping is when the primary trend was clear and I was scalping in that direction. The worst days I ever had were buying into highs or selling into lows and divergence days, or days where I would just get a look there. I'd be like, okay, they've made their range to the day. Let me step in and buy it or sell it. And then the upside leader or the downside leader is making new lows. And I didn't see that. And all of a sudden that was just enough to get me out. And then the trade worked. And so you have to recognize that the market on the bigger picture will always supersede the short term, even in the microseconds of the short term, because the flow is going to be coming from the bigger players. And the bigger players are not concerned about 2 ticks or 10 ticks. And they got to buy, or if they have to sell, they're coming in and they're taking the book until their order's filled. And so you have to understand that, right? And you're not going to get the support from the algos, which some people may look at them as the enemy in some ways, but the algos will keep the balance. So if there's some selling that comes in and you buy it and everything is strong across the board, there's a lot of machines triggering to buy versus coming in and absorbing some selling when they look at it and go, uh-oh, I may not be someone who wants to hold this bigger position. So you create a ton of weak hands in divergent tapes. I am one of those people who have a weak hand in divergent tapes too. I've clicked in and out of lows and highs where I'm like, I just sold the low tick. I just bought the high tick. But at that point, that was my pressure point. I couldn't hold it anymore. And it just somewhat happened, but they're taking you to those areas and then they come back. And so that's why this tape, I believe, is very difficult. And you have to sit back and say, when things line up and everything starts to get back in sync, the indexes will give you the cleanest looks. Until then, this is where we are.
Going into earnings season.
Another factor.
Just want to throw it out there. We're about to go into earnings season, and typically different sectors are featured, or the same companies from a sector, or not same companies, the companies from a similar sector all tend to report in, let's say, the same week period, and it goes over 4 to 6 weeks, and there are different sectors. Does that give a little bit of this divergence activity? Do you see divergence happen a little bit more during earnings season? Or obviously, you can trend right through earnings seasons if the economy is, doing well or doing poorly. But do you see any kind of more divergent activity during earnings season?
Well, absolutely. In a tape, you see it more when the tape is divergent. So the indexes will tell you the story going into earnings. And because the indexes are not clear, I can paint a picture for anybody. I can sell you on a bull market right now. I could sell you on a bear market, and I could make you believe my opinion, right? Because we have that kind of market. You could say what you want, that the bulls have won this year, but the bears won last year. And is this a mean reversion? What is this? Nobody really knows. And you don't have all the indexes believing in the same thing. Go back and look in history. When you have strong bull markets, earnings seasons, they're all pretty similar, right? You have the one-offs here and there, but you have so many. Most of those stocks are going to do very well, especially the big ones, because they've already been leading the charge and they're probably outperforming the market. So even if they take a clip at earnings, the index doesn't get impacted as much because the tape across the board is participating in the rally. That is not the case right now. So therefore, if you have one stock that's been like NVIDIA or Apple that gets a little bit derailed, think about how that impacts everything else. I mean, because now it might not impact the S&P as much because maybe they're buying healthcare or they're buying energy, right? And so you have this balance, like energy is doing really well right now. All of a sudden that and S&P is not acting as weak. And therefore you have NASDAQ where tech has done great and that's struggling. And so you just have this back and forth. So you're so sensitive to an earnings and a divergent tape. Goes back to the environment. It goes back to everything that's happening. And it's why it's so easy to get shaken out during the day, because that's impacting us, right? It's a lot of weak hands. You have weak hands and undecided divergent tapes.
Awesome. Okay. Thanks for that. Thanks for explaining that, Anthony. I think we should move on to the question of the week. If you have anything else you want to add to that.
No, I love the question of the week. I can't wait to hear what it is.
Okay, so this week it's actually a really good question, I think. Question comes from Bright Futures. It's at Bright FUTS on Twitter, and it's have you noticed a difference in the way cumulative delta behaves since the explosion of zero DTE and the resulting hedging flow? Zero DTE being 0 days to expiration. They're 1-day options.
Yeah.
So that's the question from Bright Futures on Twitter.
Well, let's pull up the 3-minute chart that I have here, and let's go to the chart and let's look at the order flow cumulative delta. So first of all, order flow cumulative delta, for everybody that doesn't know, we did a whole show on this, Tom and I. It is the net difference between what's bought on the offer and sold on the bid. And when you look at zero DTEs, just like Tom said, is 0 days to expiration. You actually have them for S&Ps now, micros too. You also have event contracts, which is actually a true zero DTE. And what's happening with this phase right now is that basically, in my opinion, zero DTEs are just SPY. They're like futures because, they're futures with less of an edge. And right, they have a place and they have a time where a zero DTE, I think, is a really good product. Like if I see something out of the money in the micros or the S&P or the SPY, and it's like, oh, I think we could have a strong trend day. It's a good time to do that and step in because you could just buy them and leave them, right? But it's a different type of a trade. It's similar to what an event contract would be because you're doing something where your loss is automatically there, right? You don't have to worry about trading a stop like you are with the future, where the future might shake you out and you might just say, look at it, I'm looking at this only in this direction today. And so the zero DTEs, and the reason why I'm explaining this is the volume is become so immense, how is that impacting regular day traders? And I will tell you this is that, and I actually responded to this tweet. I didn't know we were picking this today. And I said, I'm not seeing a lot of differences really on busy days, but on days where there's not a lot going on, I will notice all of a sudden you'll see this inflow of volume one-dimensionally around single set strikes, right? To where before you didn't have that. So 4140, 4150, if it's a strike and you get near the close, it becomes more active there in the flow because we're potentially going to close in that area. So they're offsetting futures, or people are using futures for it, or you're seeing that action that's coming from the GEX data or whatever. And so the futures traders are reacting on it. But overall, I would say it's done very minimal because throughout the time, futures, once again, are the center of the universe. And so when you see cumulative delta in futures, that is the bigger players. And so they're not necessarily doing any decision making based upon a zero DTE. Now on closes in certain times where it's like there's not a lot going on, all of a sudden I'm like, where's this volume coming from? That I've seen, but throughout the day and throughout the weeks and the months on a regular basis, I have not seen a major impact, even a minimum impact on order flow cumulative delta for the futures markets.
And, you know, I've noticed, Anthony, as well, generally at the end of the day, volume struggles to get to match what it started out at, right? The volume smile, you know, the amount of data, the amount traded at the beginning of regular trading hours versus the end struggles to meet that level. Now I see it exceed, like you said, on days where there isn't a lot of news going on or a lot of motion.
Yeah, because of course people are trading 0 DTEs and futures too. So therefore you have futures volume that's, you know, it's I think overall, like I said, it's in the random times, but as an overall, does it change the way I look at cumulative delta? No. Like today, it'll be interesting to see, you keep seeing bidding them up and maybe you can't get above a 4150 or 4140 strike, and towards the close, do they unwind that delta? Right? Do you watch that? You know, that's something where I've talked about this last week. Is it a trap, right? Or does it exceed through it? Right. And you see a ton of buying and the next day we gap down. I mean, there's different nuances you might find, but once again, overall throughout the day, I don't notice much difference. Last thing I want to talk about, because I mentioned them, is event contracts. You know, event contracts to me are the true 0 DTE. I think they're really good for this market environment. Obviously, a shameless plug to go to my website, which I'm going to take you to. You can go to cmegroup.com to learn more about event contracts, but you can go to placeyourtrades.com. This is my website. And one of the things that we've been doing a lot of us that are trading these event contracts are looking at these quant stats that we have, and these will help us in determining maybe just what direction we want to be in. And so, you know, these are just, you can watch videos on this. I'm not going to go over that, all of that right now, but event contracts are a great way to participate in a directional market with a fixed amount of risk. And for me, I'm doing more of those right now just to kind of keep my beak wet and just stay in the game. And there's certain times these are great, and there's certain times I don't think that you should use them. But for right now in Divergence tapes, I like them. So they're a great tool.
That's great. And that's at placeyourtrades.com, right?
Yeah, placeyourtrades.com. This is our member area. You can learn all about some of these things. I think this will can even help some of the traders understand directional tools. It's all free. You can go there and just check it out for the market. And, you know, these quant stats, you can click on here and watch a video on it. And it's been very helpful for me, especially in a divergent tape.
Yeah, that's great. Thanks for that, Anthony. If you have any questions, reach out to Anthony. You can reach out to him on Twitter at Anthony Crudele, anthonycrudele.com, and you know, Place Your Trades is a great site. I go there and you know, love the videos. You have daily videos. So thanks for that.
Yep. Thank you, Tom. Thank you, everybody, too, for tuning in this week. Once again, final message: don't always look for reasons to get in. Look for reasons not to do stuff.
Awesome. Thanks so much, Anthony. And thanks to the viewers for coming. We'll be back here this afternoon. Actually, I'll be back with bars closing, and Anthony and I will be back next Thursday at 10:30 Eastern. In the meantime, have a great trading day. Thank you very much.